On behalf of CrossCheck Media and Biz Talk Today TV, welcome everyone to the Torres Report. I am your host, Todd Schoenberger, and joining me, as he does for every show, is José Torres. He is the senior economist at Interactive Brokers. Jose, we have to start talking because we haven't talked in a few weeks. Actually, a lot has happened. One, you had a rather strong jobs report. You then received a cooling inflation report. Tomorrow is the all-important, all-world PCE index number that's coming out. So how should investors right now currently read the inflation stage that we are in right now?
Well, Todd, very simple. Great to see you. Great to see you. Been a few weeks. Great to be back. Real simple. Gotta buy treasuries. Inflation's at 2.4%. The federal deficit is shrinking, albeit modestly. You have those two dynamics and the 10-year at 408. Really fair value in the 10-year should be around 380, 390. I've been calling really the move in treasuries since 430 on 10s and 5% on 30s. Not as compelling as it was 2 or 3 weeks ago, this call, but still the move here is to get into treasuries, specifically duration.
Now, the flight to safety is important.
Yeah, that's part of it too, but more so the fundamental economic backdrop and where interest rates should be considering where inflation is and what's happening with the federal deficit. Why not stocks? Stocks have had 3 years of spectacular gains. This year could be a flat year. It could be a down year. Todd, the broadening doesn't have that much scale. We saw the Russell was up almost 9% year to date. The Dow was up 4 to 5% year to date, trying to offset the weakness and the sluggishness in tech. But the issue with that is that those areas of the market, Dow, Russell, more cyclically oriented, small cap focused on the latter, and they're capped from a price to earnings multiple perspective because those names in aggregate lack the spectacular growth narratives that the Magnificent Seven and the tech stocks have. For example, these stocks can't say that they're going to triple or quadruple earnings in the next 2 or 3 years, right? Magnificent Seven can. So that means that the runway for tech, which we already saw in the last 3 years, has been significant, but the broadening can't offset the weakness in tech. I think tech is due for a break here, similar to what we saw in 2018, similar to what we saw in 2022. Going into 2022, we had the pandemic, we had the work from home policies. It was all tech concentration. The tech companies were making all the money. They ramped up their spending to accommodate the work from home shift. Once it looked like the spending there was too substantial, 2022 was a down year. Similar thing here with AI. There's questions about the expenditures being too significant. You feel the mood on Wall Street. You feel the mood amongst tech investors, and it just feels like we're due for a flat year, down year here. One last point here. 2018, down year, followed by 3 great years. 2022, down year, followed by 3 great years again. So maybe it's a 3-year on, 1-year off cycle.
Yeah, it could be. I guess the question that investors have, though, is why, like we start talking about Fed rate cuts, why would we even need cuts? You have a Q3 reading on GDP was at 4.4%. You had the jobs number coming. Even the claims number today was okay. I mean, everything seems to be healthy right now. It doesn't warrant anything to give you the feeling that, okay, we might be in that bearish cycle in equities, and now we should be flying into treasuries, and then we have to worry about recession. I mean, I must be missing something here because it seems like everything's pretty good right now.
Things are pretty good, but I wouldn't say everything. Real estate still needs a little bit of easing. That area could get a little better. Small business is not an area that Wall Street cares about too much, but is a big important aspect of the economy. Their rates are too high for them, And manufacturing, early data this year has been very strong, coming off the back of the big, beautiful bills passage last year and the 100% depreciation on first year measures. That's been boosting the manufacturing numbers here. But overall, I still think that manufacturing could use some easing. Now, Todd, if those three aspects start doing well with everything else, now we're really looking at a terrific economy. So not necessarily that we need rate cuts because we're in trouble. We need rate cuts as a risk management move. Let's get into better balance. Inflation's at 2.4%. Why do we need to be at 3.5? Maybe we get down into the twos on Fed funds if inflation can stay maybe roam back to 2.2, 2.1. So there's really not a reason at this juncture to have 100 basis points of restriction on Fed funds just because the economy is doing so great. I think it's better to move lower to broaden out economic participation and also get closer to neutral and improve some of the prospects in some of those rate sensitive areas.
So are you still calling for 3 rate cuts this year?
I still think I'm still calling for 3. Lately, though, that enthusiasm has been quelled. Yesterday, the Fed minutes came out, and some officials said we're going to reverse from easing to hiking if inflation doesn't start to cooperate. So that's been weighing on rate cut probabilities. Wall Street was at around 68, 69 basis points of cuts, so almost 3. But now it's getting closer to 60, so getting closer to just 2. So we're still around the 2.5 range, but it's just the atmosphere feels like we're sticking with 2 for now rather than 3. But I still think that we're going to get 3 because inflation is going to keep coming down, Todd. Tariff effects are behind us. That's only a limited amount of inflation. Housing is losing steam from a price perspective and a rent perspective, and that's what drove that better than expected CPI reading. You don't have the immigrants, you don't have the household formation in this administration. That's going to put downward pressure on housing. Almost half of the inflation picture, goods, that's going to start becoming disinflationary. Non-housing services, though, that's really booming. You look at airfares in the CPI, you look at food away from home, you look at experience spending, concerts, Super Bowl, Major League Baseball, Baltimore Orioles,
Yeah,
New
there you
York
go.
Mets, all that stuff. It's really exciting, and folks are out there spending on services. So that's that one aspect of inflation that you gotta maybe worry about a little bit, but there's not much labor wage pressure anymore. There's a little bit, but not that much. So you don't got to worry about that. You don't got to worry about housing. You don't got to worry about tariffs. So let's cut 3 times this year.
So you're of the belief that the tariff argument that is causing inflation is behind us. What about supply chain disruptions? We hear that often, that could be a reason why inflation has been sticky. What are your thoughts?
I don't think so. No, I don't think supply chain disruptions have done much. It was pretty clear after two months after Liberation Day, kind of what the tariff levels were going to be on a country by country basis. Some
Right.
big corporates made some shifts in the supply chain. You had some folks that were in China moving over to Vietnam, moving over to Malaysia, Japan, South Korea, etc. You've had some of that going on, but I don't think that supply chain disruptions are causing any kind of inflation whatsoever, and they haven't for a long time. What could, however, cause an uptick in inflation? We're seeing that oil prices are 3% higher today. Tehran and Washington, some tensions going on there. President Trump wants them to make a deal. They're not looking to cooperate as warmly as President Trump would like. So there could be a military operation near Tehran soon, perhaps as soon as this weekend. And if oil gets up to $80, $85 and is sustained there, because folks, a spike in oil isn't enough to change inflation figures. Inflation figures are monthly and yearly averages. You need a spike and a sustained spike. You got to get up there and stay there for quite some time for those numbers to make it to the CPI and start to really affect yields more materially. But if that happens, Todd, then 3 cuts becomes maybe 1, maybe 0, maybe we got to hike. So
Yeah.
that's an extreme scenario, 10% probability, not likely. Sorry to interrupt you.
No, no, you're fine. You're fine. But that's a good segue because you're right. Because of what's taking place in Iran right now, I'm still scratching my head wondering why we're doing. I get it. We protect our allies, and it seems that it's us in Israel that's going to end up going into to take care of this action in Iran. But with that though, with oil, I'm sure a lot of oil enthusiasts out there would tell you Iran's not going to really move the needle on the price no matter what happens in Tehran. But if they close the Strait of Hormuz, then we do see that spike. You would have to think that that could have a long, at least for the next quarter, for second quarter. How would that impact as far as how would it impact inflation? But then how would it direct a new Kevin Warsh regime inside the Fed?
Well, that would impact inflation because 1/3 of energy supplies are held in the Middle East. So if you block off the Strait of Hormuz, all of a sudden you don't have those exports moving to areas in Asia, areas in Africa, areas in Europe that energy supplies need to move to. As far as how it would affect Warsh's regime at the Fed, similar to what happened with Chair Powell in 2022. If it weren't for Moscow going into Kiev, the Fed would not have had to hike 550 basis points. They would have only hiked 400 basis points, 425, because it was the oil. It's such a critical input to everything we do, not just transportation, not just goods, also services, just across the board, pivotal for what we do. Crude oil from a gasoline, jet fuel standpoint, diesel, and then of course natural gas from a more electricity and heating standpoints. So if you have that oil spike, that would absolutely deter Fed chair nominee Kevin Warsh from pursuing an overly easy policy because the inflation rates will start to pick up.
This is the first I'm hearing of this. So what you're saying is that if the invasion of Ukraine did not happen, then the Fed would not have had to hike rates as much as they did because inflation readings would have been more in check. Is that how I understand it?
100%. That's absolutely the case.
Wow, that's incredible. So then that leads to another question then. Let's say nothing happens in Iran. We somehow get a peace deal between Russia and Ukraine, and now we see oil prices plummet. I mean, we're talking sub 50 a barrel for West Texas Intermediate, which will be critical, obviously, for the industry. If that happens and inflation does drop suddenly, then does that move the needle for the Fed?
Yes, it moves it towards 3 rate cuts,
Three
maybe
rate cuts.
even 4 if it's accompanied with any kind of economic weakness, which I don't expect because the economy is running hot. But that would bring you to definitely 3 rate cuts. If you have a little bit of labor issues, that'll get you to 4.
That's insane. That's insane. That's crazy because you're going to have a GDP that could be really piping at that point, well over 5%. And it'd be interesting. I know the president will like it, but it'll be interesting to see how that plays out. Let's turn the page to Kevin Warsh right now. It looks like all systems go as far as him going through his congressional hearing, and then he has to be confirmed and gets in there in May. If all goes well and he does take over in June, you're not expecting a rate cut though during Powell's time that he's still there, right?
No, no, not expecting the first cut in June.
Yeah.
Not and just um to go back to your earlier point, which is relevant to this, Todd.
Yeah.
100 basis points of cuts, 4 cuts would get us to a range of 250 to 275. If inflation's at 2% or 2.1, we still have 40 basis points, 55 basis points, 60 basis points of restriction in the pipe. So it's not all that crazy to want to get those 4 rate cuts. And another thing, it's been a big argument by the Republican Party economists like the Stephen Myrons and some of my other colleagues as well, that you can have buoyant GDP and low inflation and a low Fed funds rate if it's supply side driven policies. So the expectation is that I'm a little bit skeptical of this, but their argument is that to cut heavy is that the AI initiatives and the capital expenditures are going to bring on so much productivity that's going to boost the level of goods and services, when you compare that to, for sakes of argument, the same amount of dollars out in the circulation, then all of a sudden that's disinflationary pressure on the economy. So that's how you reconcile really strong growth with low inflation and a low Fed funds rate, because it's not totally consumption driven. It's very much driven by business investment, not just people spending money.
Well, why are you skeptical of that happening?
Because the use cases of AI, Todd, they still, it's I'm still a little skeptical. I've been the skeptic since the beginning. It is my natural tendency. Maybe I'd be a little bit happier of a person if I was more optimistic. But
You sound optimistic.
well, when I'm with you, I'm with good company, so I can smile. But
I appreciate
it's
it.
the use cases. The technology is already, before the AI stuff, so integrated in what we did. Remember, work from home. How much AI is really going to do it. Really going to do. When you look outside of the Magnificent Seven, and outside of the companies that really have an interest in AI being the best thing ever, people are kind of don't really know what to do with it, don't really know how it's going to really contribute to the bottom line. Just a much more advanced Google search. Is that what it is? So I still think that the use cases are problematic, and I think people are cheap. Labor is not that expensive, and robots are expensive. AI is expensive, and I think that there's going to be, I don't think that the automation efforts and the go all in on technology. I don't think that the returns could be decent, but I don't think they'll be as buoyant as we expect.
Right. And the supply side theory worked in Reagan's first term. It actually led to the Tax Reform Act of 86. The problem is that people didn't take advantage of it. It seemed that if you were making the same amount of money working 20 hours, you're making 40 hours of wages, you would think people would want to work more because they're making more, they had more take-home pay. Just didn't work that way. And we did see, obviously, after Reagan and into Bush's first term, and then he had to hike taxes. So that didn't help matters at all. It would be interesting to see how that plays out now, though, because we have so much money that has been committed to being invested in this country. And, from a dollar wage standpoint, I mean, it's gigantic. I mean, we were talking with trillions of dollars, and it will be interesting to see how that plays out for the economy. With that, though, one thing I have been hearing about a lot, Jose, from experts like yourself that have been coming on BTT, they've been whispering that recession word, and it's starting to bubble up over the last couple of weeks. Not exactly sure who started this, but what are your thoughts on a recession? Do you think we're at risk of something devastating like that happening?
No, definitely not. I just don't see from where. You have this administration, pro-business administration. They're going to run the economy hot. They want fiscal stimulus, rate cuts, good ambiance for business. Employers aren't laying off workers. There's no one to hire because of the immigration restrictiveness, because you have a lot of boomers retiring. It's tough to replace them. You have demographic issues. That's why the labor numbers, I think those folks that I watched a few of those episodes, those folks that mentioned the R word, they were talking a lot about the labor market and how when this has happened in the past, it's driven a slowdown. But those historical, and with all due respect to those guests, those historical tendencies and those historical statistical relationships have been totally turned around because we have the information age and easy central bank age. This is such a different generation we're at now, not as labor intensive of an economy. Look at the sentiment indicators. Back then, consumer confidence and sentiment used to be leading indicators to recession. Now they're not. Conference board officially changing what signals a recession or not. So we're in this new age, and no one really has an appetite for it. Back then, you had an appetite for it. Reagan would tell Volcker, listen, forget about growth for now, worry about inflation. We'll take the 22% Fed funds rate. We're not in that environment these days. Let's take the medicine now. We'll have a better growth later. We'll be more happy later. No, it's about being happy yesterday, today, and tomorrow all the time. And it's just the way things are these days. So I don't see a recession unless you have a black swan.
Well, I love that optimism. That is fantastic. I want to touch on one thing. I'm not sure if you're getting state by state reporting, but one subject that has come up recently is the exodus of residents, high wage earners that are leaving high tax states. California, Massachusetts, Maryland. Maryland reported they lost 14,000 residents over the last 2 years due to high tax policies brought on by the current governor and the administration there. So, if that's the case, what kind of a negative economic impact does that have on communities in those states?
That's it's a negative effect right away, obviously, because you have the waning tax revenue and you have jobs leaving the state, investments leaving the state. You had the same thing happen similar in New Jersey when David Tepper left. You had a significant dent in the tax revenue of the state.
Mm-hmm.
Ultimately, it turns into lower growth, slower hiring, um, less young people, because then young people start to leave if taxes are too high and there aren't enough opportunities for them. Because when you raise taxes too much because you want to fund social services or whatever you want to do, you start disincentivizing business investment and hiring. And that's what young people need so that they could work, they can save, and they can move on. But then some of those states, like in the Northeast, you have some of those states have just been losing population for so long. And some have probably already peaked. Like if you look at Vermont's population statistics, Todd, they might never get back to their peak. I think it was in 2019, pre-pandemic or something like that. They might never get back there. Just have this consistent move down to the Sun Belt. Now down here, Todd, Miami's gotten too expensive. The surrounding areas as well. So now you have a lot of people heading up to the Carolinas, heading up to Southern Virginia, heading up to some areas in Georgia that are more affordable. And that shift just makes sense. So I think that'll continue to occur. The Sun Belt will continue to gain residents. And then the states that are taxed too much and they regulate too much, some of them will eventually have reversals of economic fortunes, similar to what we saw with the manufacturing renaissance in some areas of the Rust Belt that aren't as nearly as buoyant. It's pretty depressing, some of those areas when you walk by. But then you have some of the gateways. The gateways are going to be fine because in New York, first it was, you had back in the 70s, you had the insane crime and folks were leaving and, oh, we can't go back there. It's such a jungle. And you had a cyclical kind of shift. Then you had Mayor Giuliani come in. That was in the 90s and started cleaning things up. And now folks wanted to come back. And then 2001 hit, September 11th. You had folks start moving to Jersey, to the suburbs, out of state, other places. Then that started to ebb a little bit. Then you had the pandemic. And now this was it. You don't have to actually be in the city, and there's no reason to actually be in New York. Those were the talking points. But you find with the gateway cities like New York, you just have an endless supply of people that are willing to go there. So if you have 20,000 people leave, there's another 30,000 ready to go. It's like the S&P 500. It just constantly gets bid. Yo, you got 20,000 bears. There's 25,000 bulls right around the corner waiting to buy. So it's just it's quite significant. But ultimately, I think that what's been going on here down in the Miami area, South Florida, has been a great dynamic. You have low taxes, mild regulations, very business friendly environment. And I would love it if more regions around the country started to adopt those kinds of postures. I'm afraid that a lot of the cities and states are shifting way too much to the left and really destroying the incentives of hard work, production, savings, and discipline.
Do you find it? I know you follow politics. Do you find it interesting that how the narrative coming out from the Democratic Party is about affordability, and they're trying to pin the affordability argument on tariffs that were imposed from Liberation Day? So, but the Republicans seem to be staying away from going after those blue states that do have high taxes, that are causing affordability problems. It's not about tariffs, it's about taxes. Why would the Republicans not really pounce on that? Because it seems like they're they're staying away from it, which causes me concern because I'm thinking, oh, wow, we might be seeing something that must be more concerning down the line. But are your readings giving you any type of uneasiness?
Honestly, I don't think the people in Washington, for the most part, I don't think a lot of them understand economics or like weigh one argument more than the other, or like even want to go out and prove to people or want to try and prove to people that, oh, tariffs didn't cause inflation. So I think that's part of the reason why it's not shifting that way. Definitely, Republicans are playing defense here. Unfortunately, for inflation, President Trump got in with 3% inflation in January of 2025. So it's 2.4 now. And unfortunately for the President Trump and the Republican Party, we have a framework since the Great Depression where we don't want prices to go down. But that's what households want. Households want prices to go down. Don't talk to me about the rate of change. They want cheaper prices. They want $100, go to the store, buy some stuff. They find that they go to $100 and it's not enough with the $100. So that's really the bifurcation between how people in the economic world think about inflation and how people in the real Main Street, how they think about inflation. They're not 3%, 2.4. That's not a big difference to them. To us, it is, but to them, it's not.
Right. Yeah, I know. I just want to buy a cup of coffee that I don't need to buy on layaway. So so I know what you mean. All right, Jose, this was great. I mean, we're back on a regular weekly basis. The gang is back together, ladies and gentlemen. We will be back next week. Next Wednesday, 2:00 live. We're going to be talking all about that PCE number that comes out. And I know there will be a few other gems out there for us to discuss. Jose, what do you think? Great return back?
Yeah, great return back. You forgot to mention the pressure to tip 20% after you get that coffee at the airport. There's pressure. They're looking at you while the tip thing comes up on the window. So, that's another inflationary aspect. I got up. I came up to the counter. I asked you for my coffee and I got to tip you, So it's a different game these days.
That's true. And so everyone knows actually that the average price for a pound of coffee right now is over $9. It's the highest it's been in some like 30, 40 years, something crazy. So adjusted, of course, but that's nuts. I mean, that's a crazy amount. So, all right, Jose, this was great. I can't wait till next week, and we'll talk again then. So on behalf of Jose Torres from Interactive Brokers, I am Todd Schoenberger. Thank you once again for joining us on the Torres Report. We'll catch you next time. Take care.